Okay, let's dive in. We're talking about something absolutely fundamental today, right?
Yeah.
The real core of any bank.
The bedrock. Forget the shiny apps for a moment.
Exactly. The bedrock, we're talking about the ledger. It's the system for keeping score, basically. The single source of truth for every penny moving around, every debit, every credit, all neatly put into the accounting books.
Sounds simple enough on the surface, doesn't it? Like just basic bookkeeping.
Yeah, you'd think so.
And, that perception is actually where the trouble starts. Our sources suggest that treating the ledger as the sort of trivial task,
Like it's just admin.
pretty much, treating it like that without focusing heavily on the underlying tech architecture has led to some really significant systemic issues in banking, especially now with global finance operating at such incredible scale and speed.
Right. And that's exactly what we're digging into today. We've got this collection of documents, sources that really pull back the curtain on core banking ledgers, and, interestingly, a potential solution called Ledger Rocket.
So our mission essentially is to unpack all this.
Yeah, sift through these sources, find the key insights about the headaches banks have with their current ledgers, and then explore how this Ledger Rocket thing aims to fix it.
Think of it as a journey into the financial plumbing.
The plumbing, I like that. So what's the first big problem highlighted in the sources? This idea that recording who owes what gets incredibly messy.
It does. They use a fantastic term for it, ledger sprawl.
Ledger sprawl. Okay, that immediately paints a picture. Sounds disorganized.
And it is. Instead of one clean central ledger for the whole bank, you end up with this fragmented patchwork, systems built up over years, maybe decades.
So, like, the credit card division has its own ledger system,
Right, and loans has another one, payments uses something different.
and they don't talk to each other easily
Exactly. And often, each of these siloed systems claims to be the definitive source of truth, but only for its little world. This creates immense complexity.
because they weren't built to work together.
Precisely. So banks have had to build workaround after workaround. Complex, often manual processes, layered on top of this creaking legacy tech, just trying to stitch the data together and make sure it all adds up eventually.
Which sounds like it leads directly to the next big headache.
Yeah.
Reconciliations.
Yeah.
Endless, painful reconciliations.
Oh, absolutely. Imagine trying to get one accurate picture of the bank's position by pulling data from, dozens, maybe hundreds of different old systems.
Each with its own format, its own timing.
Right. It's incredibly slow, it's fragmented, and it takes armies of people to manually check and adjust things, especially when you're dealing with millions of transactions every single day. This whole reliance on after-the-fact reconciliation is a major bottleneck.
And a direct result of that must be a lack of real-time insight.
Definitely. If you're waiting for batch jobs to run overnight to reconcile yesterday's data.
You're always looking backwards.
Exactly. Getting a clear, accurate, consolidated view of critical things like the bank's total liquidity right now, or its overall risk exposure across everything it does becomes incredibly difficult, maybe impossible in a real crisis.
And all this inefficiency, this manual effort, the old tech, it must cost a fortune.
Huge operational costs, yes. Maintaining the old systems, the custom patches, the reconciliation teams, it's a massive drain. And then piled on top of all that, you've got the regulators.
Yes, the regulatory burden. Things like BCBS 239.
Exactly. BCBS 239, the Basel Committee's rules on risk data aggregation and reporting, they demand banks can pull together accurate, complete risk data very quickly, especially when things get stressful in the markets.
Which requires reliable, unified data infrastructure. Which sounds like the opposite of ledger sprawl.
It really is, and the sources cite some pretty stark figures on this, referencing Oliver Wyman analysis. Apparently, something like 27 out of the 29 biggest, most systemically important banks globally.
27 out of 29.
Yeah, 27 out of 29 don't fully comply with BCBS 239.
Wow, that's almost all of them. And the cost.
Is there a number attached to that non-compliance?
The estimate cited is potentially 500 million to 1 billion per year globally.
$500 million to €1 billion wasted annually just from these data inefficiencies.
Wasted or tied up in extra capital buffers because they can't accurately prove their risk levels. It's a huge number.
So this isn't just some, back office IT issue. It has real teeth.
Absolutely. For the banks, it means potentially massive fines from regulators, hundreds of millions. It means higher capital requirements, as we said, bloated operating costs, lost opportunities because they can't move fast enough.
And for customers like you and me, does it trickle down?
It can, yeah. Slower service, maybe a clunkier online experience,
Hmm.
potentially higher fees indirectly. And the sources even mention something interesting, this shift to a cashless society.
How does that affect things?
Well, you get way more transactions, often smaller ones, happening much faster. These old ledger engines just weren't built for that kind of constant high-velocity flow. They start to struggle or need even more patching. So the way we live now is literally straining the bank's core record keeping.
It puts the urgency into perspective. And just for scale, the sources mention banks spend something like $650 billion a year on IT out of a $4 trillion global total. A big slice of that is just keeping these old, fragmented ledger systems limping along.
Okay, so the picture is clear. Fragmented, expensive, slow, risky, and struggling. That neatly sets the stage for the proposed solution in these sources. LedgerRocket.
Yes, LedgerRocket is positioned as the way out of this mess. It's described as an ultra-scalable, API-first, unified ledger system.
Unified being the key word there compared to the sprawl.
Exactly. The ambition is for it to become the sort of ubiquitous ledger layer in a bank's tech setup.
Okay, so its main goal, its core purpose, is tackling that massive half-billion to billion-euro problem we talked about.
That's the claim, primarily for the big global banks by becoming the single trusted source of truth for all financial transactions, and crucially, doing it in a way that has compliance and auditability baked in from the start.
Not bolted on afterwards.
Right. And the benefits listed in the sources flow directly from that central idea. Things like, obviously, accurate records everyone can trust, real-time balance consistency across the whole organization.
Imagine knowing the exact cash position, company-wide, second by second.
That's the idea. And the really big one, potentially eliminating internal reconciliations altogether.
Because if the data is right going in, and it's all in one place,
There's nothing left to reconcile. That whole costly process could just disappear.
wow, what else?
Well, it supports a proper daily close process natively. Promises significant cuts in operating costs by letting banks retire old systems and manual workarounds. Reduces that technical debt mountain. Helps ensure compliance with regulations like BCBS 239. And, importantly, makes it faster to launch new products because the core ledger can handle new transaction types easily.
That's a compelling list. But how? How does it actually achieve all that?
Well,
What makes LedgerRocket different under the hood?
the fundamental difference, according to the sources, is its architecture. It's designed as a real-time financial transaction engine.
Okay, what does that mean in practice?
It means, unlike the old way, where stuff happens in the bank systems first and then gets sent to a ledger later for recording and reconciliation.
The rearview mirror approach.
Right. LedgerRocket sits directly in the transaction flow. When some other system, like payments or loans, needs to make something happen financially.
It talks to LedgerRocket first.
Exactly. It sends a request to LedgerRocket synchronously, instantly.
So before the transaction is actually finalized or committed anywhere else.
Precisely. LedgerRocket receives the request and immediately validates it.
Validates against what? The current balance?
Yes, against the current state of the ledger, does the account exist? Is there enough money? But also against a powerful set of configurable rules.
Yeah, okay. Rules.
Yeah. And only if the transaction instantly passes all those checks does LedgerRocket actually record it.
So it flips the script instead of cleaning up errors later.
You prevent invalid or non-compliant transactions from ever getting onto the ledger in the first place. Control and compliance are built into the transaction moment itself.
That makes sense. What kinds of rules are we talking about?
The sources describe two main types. First, there are product-specific rules. These are often defined using templates, maybe by the teams actually building the loan product or the payment service.
So the product teams still control how their specific product events hit the books.
Yes, that's key. They map things like customer makes payment or interest accrues to the correct double entry accounting posts. It gives them autonomy.
Okay, preserves innovation speed. What's the other type?
The other type are cross-cutting rules. These are defined centrally by departments like compliance, finance, treasury.
The guardians of the overall financial integrity.
Exactly. These are the non-negotiable financial controls that apply everywhere, no matter which product is involved. Think limits, regulatory checks, internal policies. These rules cannot be bypassed.
Got it. So product teams define the what, but central teams define the guardrails, the must-nots and musts. And LedgerRocket enforces both.
Yes, it has what the sources call explicit authority. It has rejection authority. If a request breaks any rule, product or central, bam, it gets blocked or flagged immediately. No bad data gets in.
And the flip side.
Approval authority. If everything checks out, it instantly records the transaction into immutable double entry records.
Immutable, meaning it can't be changed afterwards, like ever.
Correct. That's fundamental. The sources mention it's built using a technology called Tiger Beetle.
It's Tiger Beetle.
Yeah, apparently it's purpose-built for high-performance, super reliable financial transaction processing. It creates this append-only log. You can only add new entries. You can't alter old ones. It's a permanent, verifiable record.
So it provides that core integrity.
Absolutely. And they even mentioned potentially using blockchain anchoring, not as the ledger itself, but as an extra layer to cryptographically prove that the ledger data hasn't been messed with.
Okay, so not a blockchain ledger, but blockchain for verification. Interesting distinction. So how does this slot into a bank's overall tech landscape? It doesn't just replace everything, right?
No, and the sources are clear on this. It becomes the single authoritative ledger for financial transactions, the one place everyone goes for the definitive financial state.
The single source of truth. For real this time.
Hopefully, yes. But, and this is important, it doesn't aim to replace the entire core banking system overnight. Banks still have their systems for defining products, managing customer interactions, running operational workflows.
So the loan origination system still originates loans.
Right. But when that system needs to actually book the loan disbursement or record a repayment, it makes an API call to LedgerRocket. LedgerRocket processes it authoritatively, validates it, records it.
Okay, so it supports that more modern modular approach, sometimes called coreless banking.
Exactly. You break down the old monolith into specialized components that talk to each other via APIs. LedgerRocket becomes the specialized, authoritative ledger component. The fact that it's API first is key to making this integration smoother.
That really is a paradigm shift then. You keep the parts of your system that differentiate you, that face the customer, but you swap out the messy foundational ledger layer for something clean, real-time, and inherently compliant.
That's the vision. And the sources really hammer the contrast between the old ledger sprawl, multiple systems, post-fact reconciliation, and this new unified model where standardization and control happen right at the point of entry.
Making reconciliation basically unnecessary.
That's the goal, which fundamentally changes how compliance works, too. It's not a separate checking step. It's embedded in the process.
Leading to those big potential cost savings by eliminating the reconciliation teams and effort.
Exactly. And think about audits. If the ledger is immutable, append only, and controlled by strictly enforced rules.
Auditors can have much more confidence in the data.
Precisely. It enables what's called a control-based audit. Instead of auditors painstakingly tracing masses of individual transactions,
Which must take ages.
they can focus on verifying that the system's controls, the rules, are designed correctly and operating effectively. It's potentially much more efficient and provides stronger assurance.
And because it's real-time and controlled, you get that immediate visibility we talked about earlier.
Yes. Real-time balances, real-time liquidity views, real-time consolidated positions across the whole bank. No more waiting for overnight batches.
Which must make things like the daily close process much simpler.
Natively supported, rather than a frantic nightly scramble. The sources also mention organizational benefits, finding that balance where product teams have autonomy via templates, but central finance and compliance maintain control through the cross-cutting rules. It could reduce some internal friction.
And the idea is that by making the ledger a reliable utility,
Almost like electricity or water for financial data.
it frees up the bank's smart people to focus on innovation and customer value, not just fixing the plumbing.
Exactly, commoditizing the core ledger function so you can differentiate elsewhere.
Let's connect this back explicitly to BCBS 239. How does this approach help with those specific regulatory demands?
Well, the sources map features directly to the BCBS principles. Take Principle 2. Accurate, complete, and timely risk data aggregation. LedgerRocket's high throughput, they mentioned figures like 200,000 transactions per second.
200,000 per second?
Like it's zero data loss guarantee. And the real-time consistent balances directly address the need for timely and accurate data.
What about adaptability? Principle 3 talks about adaptable systems.
The modular API-driven nature helps there. And they mention using AI, specifically LangChain, to help draft the templates for new product rules more quickly, so faster adaptation. Plus, features like immutability and the strong integrity checks directly support principles around governance, maintainability, and auditability.
It seems like a strong alignment. And those financial benefits we touched on earlier linked to compliance and efficiency. They were pretty substantial.
Yeah, the numbers cited from that Oliver Wyman analysis are striking. Potentially reducing capital requirements by, say, $100 million, cutting the cost of funding liquidity buffers by maybe 10, 20 million P&L.
Avoiding those extra capital charges from regulators.
Right, avoiding data-related capital add-ons that could be worth 270 million depending on the bank's size, avoiding massive fines, maybe up to $400 million, and significantly reducing the size of those data adjustment and reconciliation teams, maybe by 50%.
Add all that up, and the business case seems pretty powerful.
It certainly aims to be.
So who is this actually for? Who's the target audience?
The sources suggest it's pretty broad. Starts with, say, mid-sized fintechs or banks that are growing fast or really focused on having a modern tech stack.
Digital native crowd.
Yeah, but also very much the large, established global financial institutions, the ones really feeling the pain of legacy tech debt and regulatory pressure.
The ones facing that 500-meter 1BN problem.
Exactly. And they even see potential beyond banking utilities, telcos, any industry with high-volume, complex financial record-keeping needs.
So it's trying to help everyone from the CTO managing the tech to the CFO and chief compliance officer worrying about the numbers and rules.
That seems to be the goal, providing that foundational layer they all rely on. Their go-to-market involves direct sales, but also, crucially, partnering with consultancies. Like Oliver Wyman relationship mentioned, those partners help big banks manage these kinds of major transformations.
Makes sense for large enterprise projects.
Yeah.
What about the business model? The sources called it sticky.
Yeah, very sticky. Which likely means once a bank integrates this as its core ledger, its single source of truth.
They're not likely to rip it out easily.
Exactly. It becomes fundamental infrastructure. The model probably scales with usage, maybe transaction volume, so as clients grow, revenue grows. But the key point was that the underlying costs don't grow proportionally, suggesting good potential profitability, especially with larger enterprise deals, which they expect to drive most revenue.
And for the tech folks listening, what's under the hood? You mentioned Tiger Beetle.
Right. The stack mentioned includes Go and Python, probably for different types of processing workloads. Tiger Beetle, often paired with something like PostgreSQL for reliable storage. It's built on a microservices architecture for flexibility, runs on AWS but designed for multi-cloud, uses tools like AWS Athena for querying the data, and that LangChain AI integration for helping automate things like rule drafting.
But the AI isn't essential for the core function.
No, they seem clear on that. The AI helps with efficiency, but the core ledger processing relies on the deterministic, reliable components like Tiger Beetle.
Okay, so wrapping this up, if you had to give the elevator pitch for Ledger Rocket based on these sources, what would it be? Why choose this?
I think it boils down to a few things. One, the team's expertise in this specific domain. Two, the technology itself validated, modern architecture, with partnerships like Oliver Wyman adding credibility for banks. Three, the promise of faster time to value.
Getting benefits in months, not years, like a full core replacement.
That's the claim. Fourth, its position as a future-proof platform, scalable, flexible, AI integrated. And finally, the core value proposition, ubiquity.
Becoming that indispensable unified financial data layer.
Right. Tackling ledger sprawl head-on, eliminating silos, cutting complexity, and shifting the ledger from being a costly problem to a strategic advantage. Centralizing everything into one cohesive, real-time, controlled system.
This has been a fascinating deep dive.
Yeah.
It really highlights how something seemingly basic like a ledger can become this huge bottleneck, and how rethinking its architecture could unlock so much potential.
It's moving from just recording history, often imperfectly, to controlling the present accurately and in real time.
So a final thought for your listener to mull over. Consider how absolutely central the ledger is, the ultimate record of financial reality for an institution.
Yeah.
Now imagine shifting that core system, moving it from being this fragmented, messy, backward-looking thing that needs constant fixing.
To being a unified, real-time, inherently compliant engine that prevents errors before they happen.
How might that fundamental change ripple outwards? How could that kind of deep infrastructure shift hidden away inside the bank ultimately affect the financial products and services you use every day? Think about speed, cost, personalization, transparency. What becomes possible when the very foundation is rebuilt?